The Power of Asymmetric Bets, a veteran investor's doctrine. Cold open, the bet that changes everything. If you only need to be right once to change your life, why are you structuring your investments so you must be right every time? Reality shock, the symmetry trap. Most investors think in symmetry. They believe if I risk 10%, I should aim to gain 10%. If I want big rewards, I must take big risks. Higher return always equals higher danger. It sounds rational. It sounds balanced. It sounds fair. But markets are not fair. And balance is not where fortunes are made. Here's the uncomfortable truth. Most portfolios are designed to survive average outcomes, but wealth is created in extreme outcomes. Look at what actually builds disproportionate wealth. Venture capital funds lose money on 70 to 80% of their investments. Top hedge funds make the majority of returns from a handful of trades. Early investors in transformational assets often endure years of stagnation before one explosive move changes everything. We tell ourselves investing is about consistency. In reality, it's about asymmetry. The market does not reward being right frequently. It rewards being right disproportionately. The amateur trusts to avoid losses at all cost. The professional accepts small losses in exchange for rare, life-changing upside. This is where the mental shift begins. Third, framework model, the asymmetry engine. Let's define it clearly. An asymmetric bet is one where downside is limited and known. Upside is open-ended and potentially exponential. Think in ratios, not percentages. If you risk $1 to potentially make $3, that's 1 to 3. If you risk $1 to potentially make $10, that's 1 to 10. If you risk $1 to potentially make $100, that's asymmetry. But here's the part most people misunderstand. Asymmetry is not about probability. It is about payoff distribution. A bet can have low probability and still be rational if the payoff multiple is large enough. This is expected value thinking. Expected value equals probability times payoff. If a bet has 10% chance of 10x return, 90% chance of losing 1x, expected value equals 0.1 times 10 minus 0.9 times 1 equals 1 minus 0.9 equals plus 0.1, positive, even though you lose most of the time. This is psychologically uncomfortable. Humans prefer high probability, small wins, but small wins compound slowly. Asymmetric wins redefine trajectories. The asymmetry triangle. From decades of observing markets, I reduce asymmetric investing to 3 pillars: limited downside, uncapped upside, controlled position size. Remove any one of these and asymmetry collapses. 1. Limited downside. You must know the maximum you can lose before you enter. This is not optimism. This is structural containment. Examples: buying a call option, maximum loss is premium paid. Early stage investment with fixed capital allocation. Allocating 2 to 5% of portfolio to high-risk innovation. The mistake most investors make is betting asymmetrically in theory, but symmetrically in size. They say, this could 10x. Then they allocate 40% of their capital. Now it is no longer asymmetric. It is existential. Asymmetry requires emotional detachment from outcome. Position size creates that detachment. 2. Uncapped upside. True asymmetry requires open upside. Capped gains destroy asymmetry. If you sell too early, you collapse the payoff curve. Most investors cut winners early and hold losers too long. That behavior mathematically destroys asymmetric return profiles. You must allow outliers to run. Outliers feel uncomfortable. They look too high. They attract criticism. But wealth does not come from trimming extraordinary outcomes to feel safe. 3. Controlled position size. This is the bridge between courage and survival. Without position discipline, You either bet too small, no impact, or too big, career-ending risk. Professionals think in portfolio math. If 8 out of 10 asymmetric bets fail, but one returns 15x and one returns 30x, the portfolio outcome is extraordinary. If you survive the journey, survival first, asymmetry second, never reverse that order. Historical examples of asymmetry. Think about transformational shifts, early internet adoption, smartphone revolution, AI infrastructure cycles, decentralized finance waves. In each cycle, most projects failed, most investors exited early. But a handful of positions generated outsized returns. The key was not predicting perfectly. It was structuring exposure so that being wrong was tolerable and being right was explosive. That is asymmetric construction. Why most people fail at asymmetric bets? Because they confuse volatility with risk. Volatility is price movement. Risk is permanent capital impairment. Asymmetric opportunities often look volatile, so the crowd avoids them. Ironically, the real risk is owning stable assets with limited upside during structural change. Safety can be symmetric, and symmetry can be expensive. The emotional barrier. Asymmetric investing demands 3 uncomfortable traits: acceptance of frequent small losses, patience for long flat periods, emotional resilience during explosive gains. Most people fail at stage 3. When a position doubles or triples, fear of losing profit overrides long-term asymmetry. They lock in gains and unknowingly convert a 1 to 20 opportunity into a 1 to 2 trade. Comfort kills asymmetry. The portfolio construction blueprint. Here is a practical allocation model used by disciplined investors. 70 to 80% in stable, compounding core assets. 10 to 20% in moderate growth opportunities. 5 to 10% in high asymmetry bets. This structure ensures stability funds survival. Asymmetry fuels acceleration. Without a stable base, asymmetric bets create emotional instability. Without an asymmetric exposure, portfolios stagnate. Balance does not mean symmetry. It means layered risk architecture. 4. Silent pause. Let the math sink in. Pause for a moment. Imagine you only need one 20x winner every 5 years to outperform almost everyone around you. You do not need to be brilliant daily. You need to be prepared structurally. Most investors chase frequency. Professionals chase convexity. Convexity means gains accelerate as outcomes improve. Linear thinking produces linear lives. Convex structures produce nonlinear results. At this point, the idea begins to unsettle the old framework. If you accept this, you no longer obsess over being right. You obsess over payoff structure. You stop asking, will this work? You start asking, if it works, how big can it become? That question alone reshapes behavior. V. The hidden mechanics. Why asymmetry feels wrong. If asymmetric bets are so powerful, why doesn't everyone build portfolios this way? Because asymmetry violates human wiring. Your brain evolved for survival in predictable environments. It prefers certainty over magnitude, frequent validation over rare transformation, social consensus over solitary conviction. Asymmetric investing demands the opposite. You must accept being wrong often, looking foolish temporarily, sitting through uncertainty. Watching others outperform in short bursts. This is psychologically destabilizing. When 8 out of 10 asymmetric bets fail, the amateur sees incompetence. The professional sees variance. Variance is not error, it is distribution. The problem is not losing. The problem is misinterpreting losing. Most investors expect linear reinforcement, right decision, immediate reward, wrong decision, immediate punishment. Markets do not operate this way. In asymmetric environments, right decision, frequent small losses, rare outsized gain. Wrong decision, frequent small wins, eventual catastrophic loss. That reversal confuses most people. Asymmetry is not evenly distributed across time. There are structural windows when convexity expands, technological inflection points, regulatory regime shifts, liquidity expansions, panic-driven dislocations. During stable equilibrium periods, markets price assets efficiently. Asymmetry compresses. But during transitions, pricing becomes uncertain. Uncertainty widens payoff curves. That is where asymmetry lives. The key insight: you do not hunt asymmetry daily. You prepare for it patiently. Most investors are always in action mode. Professionals alternate between observation phases, capital preservation phases, deployment phases. Capital should be deployed aggressively only when payoff distributions are distorted. If upside is capped and downside unclear, it is not asymmetric. If upside is massive and downside survivable, lean in. A liquidity lens. Liquidity changes asymmetry. In expanding liquidity cycles, speculative assets gain convexity. Narratives amplify upside. In tightening liquidity cycles, asymmetry often shifts to defensive structures, deep value dislocations, special situations, assets priced below replacement cost. Asymmetry does not disappear, it relocates. The investor who understands this does not panic during contraction cycles. He redefines the payoff landscape. The 5 deadly mistakes that destroy asymmetry. After decades observing markets, I see the same 5 errors repeated. Oversizing the bet. Asymmetry dies when risk exceeds emotional capacity. If a position keeps you awake at night, you will exit before convexity unfolds. The math may be correct, but behavior overrides math. Asymmetry requires psychological survivability. 2. Trimming winners too early. This is the most common error. You take 100% profit and feel intelligent. But if the opportunity was 1 to 20, you just converted it into 1 to 2. The small gains feel productive. The lost convexity is invisible. Professionals allow partial trimming while preserving core exposure. They protect asymmetry. 3. Averaging down without structure. Not every falling asset becomes asymmetric. Some become zero. Asymmetry requires thesis validation. If the underlying thesis breaks, adding capital destroys payoff structure. Discipline defines the boundary. 4. Confusing narrative with optionality. A compelling story is not asymmetry. True asymmetry requires scarcity, structural adoption potential, limited dilution, real optionality expansion. Optionality means upside increases as uncertainty resolves. Most speculative assets do not possess that quality. They possess marketing. The final mistake is timing impatience. Convex assets often move after long dormancy. Investors abandon them just before structural breakouts. Why? Because boredom feels like failure, but asymmetry frequently incubates quietly. At this stage, something should feel different. You are no longer thinking, how do I maximize win rate? You are thinking, how do I maximize payoff asymmetry? Win rate is ego-driven. Asymmetry is math-driven. If you need to win 70% of the time to feel competent, you cannot execute asymmetric strategies. The best venture investors in the world are wrong most of the time, yet they outperform because they optimize for outliers. Outliers drive everything. In wealth distribution, in company growth, in technological adoption, in portfolio returns, the world is power law distributed. If returns follow power laws, your strategy must reflect power laws. Symmetry assumes normal distribution. Markets rarely behave normally. Imagine 2 investors over 10 years. Investor A wins 65% of the time, average gain 8%, average loss 7%. Investor B wins 25% of the time. Average gain, 300%. Average loss, 10%. Who appears smarter in year one? Investor A. Who builds generational wealth in decade one? Investor B, but only if Investor B survives volatility. Survival plus asymmetry is an unbeatable combination. Remove survival, collapse. Remove asymmetry, stagnation. You need both. Pause and feel that. Here is the truth that permanently changes perspective. You do not need many great investments. You need a few structurally asymmetric ones that you do not sabotage. That is it. Most people diversify away convexity. They build portfolios designed to avoid embarrassment. Embarrassment avoidance is incompatible with exponential outcomes. If your downside is survivable and your upside is nonlinear, you must allow time to compound optionality. The power is not in predicting perfectly. The power is in structuring exposure so that one breakthrough matters more than 10 small mistakes. Once you internalize this, you stop chasing activity. You start designing payoff curves. You stop asking, what is everyone buying? You start asking, where is upside mispriced relative to downside? This is not optimism. It is structural leverage on uncertainty, and uncertainty is permanent. Asymmetric bets rarely look obvious in real time. They look uncomfortable, early, volatile, criticized. They do not feel safe. They feel uncertain. But uncertainty is the birthplace of convexity. If you construct your life around avoiding uncertainty, you will also avoid nonlinear outcomes. In investing, as in life, most results are symmetric. A few are transformative. The difference is not intelligence. It is structure. Design your risk so that being wrong is tolerable. Design your upside so that being right is unforgettable. You do not need to win often. You need to win disproportionately. And once you see that clearly, you can never think about risk and return the same way again.